Big voices and ahead of the Fed, it's a very important voice that we're joined by with Gargi Chaudhuri, Managing Director and Chief Investment and Portfolio Strategist Americas at BlackRock, with us on the show today to talk about her thoughts of what happens next. So Gargi, good having you. Thanks for joining in. What do you expect the Fed to say and do this time around, and the subsequent impact on risk assets?
Just over the last 4 days or so, the probability of getting something larger than a 25 basis point cut has moved higher. I think there are a couple of reasons that investors and anyone that's watching the show should focus on as it pertains to the Fed. Obviously, this is going to be the first of what we think is many rate cuts. So this is the beginning of a rate cutting cycle. Of course, whether it's 24 or 50 will matter that on the day off and for the first couple of hours after the FOMC meeting and the press conference. But I think in the larger scheme of things, what's really going to be important for both bonds and stock investors is around the depth of this cutting cycle and the speed of which. And most importantly, I think the third thing that investors should focus on is why the Fed is cutting rates. Are they cutting rates because inflation is coming down in a meaningful manner, or are they cutting rates to stave off a recession? And I think those are the things that are going to drive the markets in, after the first 24 to 48 hours.
Okay. What do you think, Gargi, is the impact of the Fed move based on history? Because we've seen history, looked at 2019, maybe 1995, and looks okay. 2001, 2007 don't look okay. So how do you think the markets or risk assets do based on what the markets have done traditionally in the past?
Absolutely. And, my team and I have spent a lot of time sort of analyzing the data around previous rate cutting cycles. And we've gone back to periods. And some of those periods have obviously followed with a recession. So the Fed has begun to cut rates because of the fear of a recession, or in the case of obviously 2020, which is the most recent cycle, in the midst of a recession. There were other periods, obviously 1995 comes to mind, as well as 2019, as you correctly point out, which were not in the midst of a recession. So I think how the data and how the returns are going to pan out is going to be important. As of today, and as of the time that the Fed, goes into their very important decision-making process, the data is certainly moderating. The data is certainly weakening, especially, we've seen the labor market in the US softening a little bit from about 6 months ago, but none of the data yet is actually in recessionary territory. And I think that difference is really meaningful. So the level versus the change. So the level is actually, it's softer than it has been in especially the first part of this year and last part of 2023. But if we look at the change that's gone through, obviously the data is weakening. So I think as of right now, we're not really, whether we look at the manufacturing sector, whether we look at the consumer, whether we look at the labor market, none of that is pointing to a recession. Of course, that can change. And a lot of that will depend on how the Fed handles this cutting cycle. With a recession in our forecast, I think the data shows that 12 months into the cutting cycle, equity market returns tend to be very positive. We're telling investors certainly to stay up in quality in this period of slowing growth. We're certainly telling investors to take a very strong advantage of the incredible income that's available in the fixed income market. So there are a lot of opportunities. And as of now, we're trying to tell investors how to position their portfolio in the case that we don't have that deep recession.
Will be my next question to Gargi, but just before, Gargi, just stay on, because I just want to tell our viewers, the market seems to be positioned for a 50 basis points. What if we get only 25 basis points because of precisely the reason that Gargi mentioned, that the economy is not in as bad a shape as people think? Because remember, yesterday official figures showed that the US retail sales in August were actually stronger than anticipated. And as per a Goldman note, US financial conditions are the loosest since April 2022. So in some sense, some people would argue that we don't need a 50 basis points. It's okay if it's only 25, but just that the market is currently working with 50. Now, Gargi, be that as it may, my question to you is, what is the best way, or where is $100 best split in this easing cycle? Developed markets, equities, bonds, emerging market equities, bonds, how would you split?
Yeah, I think a lot of that will depend on what your investors' sort of horizon is and what their goals and investment objectives are, right? So there'll be a lot of investors that are certainly closer to their retirement age, and they'll spend a lot of that hypothetical dollar. A lot of that will go towards income-generating assets because they don't want to have too much of their portfolio in that growth and that equity part of their portfolio, and especially globally, but certainly in the U.S., fixed income markets are garnering such a tremendous amount of income that I think that makes a lot of sense. If you're younger in your career, certainly those that are investing for the first time or investing and you have many, many more years of working left, some of that dollar, a lot of that dollar certainly should be going towards growth equity and certainly going towards areas of the world where we think growth is going to come from in the years to come. And emerging markets, certainly fit that bill very well. When we look at certain parts of the emerging market, and obviously India and Mexico are examples of this, where we're going to see a couple of things. We're going to see demographics remain very positive. We're going to see central banks remaining very much, in accommodative territory. I think in those markets, I think playing for some of that in the long term makes a lot of sense. But, it's very difficult for me to sit here without looking at an investor's portfolio or understanding their risk objectives to say that this is exactly how it should be played out. I think it very much depends on your investment objectives and your years till retirement. What I will say is no matter who you are or where you are in your investment journey, I think recognizing that fixed income markets today, especially I will say in the US, are very different from what they were sort of 10, 15 years ago when many of us started our careers. And I think that really makes things very different in this market. You can earn that income in fixed income, which for a long, long time after the financial crisis of 2008, you could not.
Okay. Point well noted. Okay, let's talk about what Indian investors can do when it comes to fixed income markets in the US too. I mean, Gargi, we look at TLT very, very actively too, and that's the instrument to invest into, one of the instruments to invest into US fixed income markets. So my question to you is, are you inclined to invest into the US fixed income markets? Is there more juice left there?
I love that you're looking at TLT. That's our bread and butter. So I love that we're talking about TLT in India. I do think that TLT, for those who are not as aware, is really looking at the very long end of the treasury market in the US. And certainly for those investors that are looking to increase the interest rate sensitivity of their portfolio, holding something like that makes a lot of sense if you want to increase the duration of your portfolio very quickly. What I will say is, as we're thinking about the entirety of the interest rate spectrum of the entire yield curve, where we're finding the most amount of interest right now, or most amount of valuation right now, is really in the belly of the curve. So we call that the 3 to 7 year part of the curve. And the reason we think that the 3 to 7 year part, so something like a BINC, which is an active ETF, or even an IEI, which is an index ETF, some of those make a little bit more sense, we think, because the longer end, so something like a TLT, can be impacted by the rising issuance that's going to come in the United States because of the rising deficits here. And the very front end, which is sort of the 1 or 2 year part of the yield curve, is already pricing in a tremendous amount of rate cuts. So we're currently looking at over 225 basis points of rate cuts between now and 2026. It's going to be very difficult for us to realize all of that. So we think that the belly of the curve, so the 3 to 7 year, is the most attractive right now. And that's where the valuations we think are befitting for investors for the time being. But certainly, depending on your horizon, depending on what you're looking for in your portfolio, many investors are grabbing for yield right now. They want to lock in. And TLT has been an excellent use case for those investors. And that makes complete sense as well. So I think the use case matters a lot.
Got it. Okay. Now, Gargi, when I was thinking about what could happen, and somehow I thought that maybe rates could go back all the way to this 2019 lows. And and therefore this whole higher for longer trade will reverse fully. Do you agree with me, or do you think about it differently?
Of course. So, absolutely. So, if we look back to where 2019 and where we were when the Fed started cutting in 2019, we were already in the high twos, if we think back to. So, when they started cutting in 2020, of course, they brought rates back to zero, but at that point, Fed funds futures were in the mid twos to high threes, so 2.75 or so. Actually, if we look at where Fed funds are today, before the Fed has cut rates, obviously, we're at 5.375. But what the market is pricing in by 2026 is right at that 2.75%. So the market has already sort of priced in a lot of that rate cut. So if you look at the futures market, it's predicting that rates in about a little less than 2 years' time is going to get back to that 2.75% level. Now, our view here is that inflation, in the pre-pandemic era, so if we look back at CPI or PCE inflation from 2000s to 2020, it was always a little bit below the Fed's target. So it was somewhere around 1.8% on CPI. We don't think that we're going to get back to that era. So for us to imagine that rates are going to go all the way anywhere near 0 or even 2% is very unlikely. So I think how the Fed signals, especially at the September meeting, around where the level of neutral rates is, and of course that neutral is that level that neither slows nor accelerates the economy, that level of neutral rate is not, we don't think, is back to being 2% or even lower than that. I think we've got enough evidence that that's somewhere around 2.5%, not even higher. So hard to imagine that we're going to get back all the way, below 2, but the market has gone a long way to pricing in, Fed funds going back to 2.75. That's where it's sitting right now. So when you talk about 2019, some of the pricing is already there. However, in the belly of the curve, which is again that 3 to 7 year part, which is the one we prefer, you haven't quite seen the move. So the 5-year Treasury certainly has a little bit more to go. And that's where we think investors should be thinking about locking in yields, not just in treasuries, but also in high yield and securitized assets, as well as in certain parts of investment grade credit and emerging markets.
Okay. My last question, Gargi. Is this gonna be a swift easing cycle? And therefore, if that is the case, what is the attractiveness of emerging markets in this cycle, let's say till the end of the year or otherwise?
Yeah, so the two different lines of thought here. On the fixed income side, certainly the belly of the curve. On the equity side, we're telling investors to go with higher quality equities. We're telling investors to sort of continue to think about companies that are returning very stable, looking at very stable earnings growth, as well as low leverage. So it's, two different parts of your portfolio. Certainly focus on those large cap companies in the equity markets. As far as emerging markets are concerned, I think that in the near term, so by that I mean maybe between now and the end of the year, there are a couple of things that could serve as a little bit of a headwind. Obviously, U.S. election being on top of mind. I think once that's passed through, I think emerging market equities as well as emerging market debt could once again be a very strong part of any investor's portfolio, as it always should be. But I think your investors should be a little bit cognizant that right now going into the U.S. elections could be a period of a little bit of volatility for emerging markets, and certainly for that matter for U.S. equity markets as well, which is also why we're telling investors to be up in quality, focus on earnings growth, be in those companies that are likely to have the most amount of cash flow, and we think that that's going to preserve you a little bit better in a volatile period.
Gargi Chaudhuri, such a pleasure talking to you today ahead of such a big day. So thanks for taking the time out and being with us. That's the view from BlackRock. It's as informed as they come, and really important to get this view all the way from New York.